All right. Guys, I am so excited for Profit Pathway today. We're here with Sarah Sullivan, and she is sharing all the things about apartment syndications and what you guys should be doing if you want to get into an apartment syndication. And, guys, we talk about this all the time. Real estate, buying businesses, apartment syndication, business syndications, why we should do each one. And before Sarah starts, I want to make sure that you guys understand why we are doing apartment syndications and when that looks good. So apartment syndications are great if you have passive income, and these would be passive losses. If you're looking for somewhere to stick your money that has higher returns than the market, but you don't have to do much for them, meaning very off. You're kind of hands off with apartment syndications.
Totally.
Or if you're a real estate pro, your real estate pros can take advantage of apartment syndications, and we group those with your other properties. So I'm going to hand it over to Sarah and let her talk about all things apartment syndications.
All right, awesome. Thank you, Carlotta. So I'm going to talk about apartment syndications, but I'll go through what the structure looks like. And it's just going to be like a model structure. It's not a specific offering. But I want you guys to know that it's like this same structure is applied to all different kinds of syndications. So like a retail park, a medical office park, mobile home park, storage units, pretty much any type of commercial real estate. You can take the word multifamily out and put in another word, and you can have a syndication around that. Now, the numbers around the depreciation are going to be really different. Usually the apartments have the highest bonus depreciations, the highest tax advantage, but everything else is usually pretty similar. So I have a little presentation. I'm going to start presenting. Let me just, am I able to share my screen? Yes. All right. All right. Can you guys see everything good?
Yeah. Yes, you can.
Okay. All right, cool. So I'm going to talk about how to analyze a multifamily real estate opportunity. And so like I said, I'm going to go through what is a syndication. You can replace the word multifamily with something else if you like a different kind of investment. And I'm going to give really high kind of the terminology you need to know, the structure, and how to do due diligence. And I have like a whole 3-hour class on how to do due diligence, but I'll just highlight it here so you can say like, oh yeah, that looks like something I want to get into and learn more. All right, so this is what I just said. What's a commercial real estate syndication, how it's structured, what do the returns look like, and then how to evaluate an opportunity. That's what we'll run through. So as way of introduction, I'm Sarah Sullivan. I'm the founder and CEO of SuGo Capital, and we connect investors to strong passive income opportunities. Keywords being passive, meaning you don't do any of the work, your name's not on the loan, your name's not on the deed. You literally park your money and someone else does all the work. That's what I connect investors to. So I have an invitation at the end to meet with anyone. So stay till the end and you'll see how to connect with me. And I'll go really quick through this. This is just usually what's in my presentation. It's some history. So I grew up doing like the very traditional path in life, like get straight A, go to University of California, San Diego, go to a good school, get your MBA. This is the way to a successful life. And a lot of you who are on here and a lot of you who work with Carlotta, you know that that is a path, but being an entrepreneur or being in real estate is another path that can be even more successful, and you're much more in control of your success. So I found the path to entrepreneurship in real estate about 10 years ago. So after I'd gone through all my schooling and I climbed the corporate ladder and I was director of engineering at tech startups in Silicon Valley, and I was like, I am working so hard, but not making any more money. Someone else is making all the money. So I started studying real estate at that time. You guys might be familiar with RE Mentor or the Rich Dad, Poor Dad University. So I started going to all the, their classes and stuff like that 10 years ago, and workshops, and learning about over 15 different types of real estate. And if you guys want, I do a whole webinar on that, 15 different types of real estate and how to compare them so that you know what's right for you and your investing goals. And what I settled down on was syndications. Was perfect for me. And it's usually perfect for people who either have a W-2 job or they're entrepreneurs and they don't want to spend, they have some money, but they don't want to spend any time working in real estate. Again, syndications 100% passive. Okay, so just to tell you what my personal results are and were. So I started out with houses. This is a before and after. Normally, the before and after, the before is worse and the after is better. But I had really bad tenants that destroyed my property, and it happened more than once. So I lost money in single family, and I know that other people are very successful, but for me, it was not a good fit. So then I started doing apartment syndications and as a passive investor while I was still at my W-2 and hotel development. And then I was getting 18 to 25% annualized returns on my money. And I was like, this is way better. There's no work and the returns are better. So then I started telling my friends and family, and they started asking, how can I do the same? When I became an entrepreneur, other people were asking how I can do the same. And so here's just some examples. I'm going to tell you, these are some of the first people that I started working with, just so you know how passive this can be. So this is Susan. She lives in California. She invested in this apartment building in Texas. She's not on the loan. She's not on the deed. She does none of the work. She gets a monthly check. And when the project exits, she's due to get 21% annualized returns on that investment. And then this is Emil. He lives in Colorado. He invested in this apartment building in North Carolina. Again, his name's not on the deed, not on the loan. He does none of the work. He gets a quarterly check for his cash on cash return, and then has an annualized return of 20% is what was estimated. And actually, this property is selling, and he's going to get close to 45% annualized return on his investment. And that's, the people that I work with, who are on the management side, they do really conservative underwriting. And so people who are exiting these projects now are seeing numbers that are higher than what their annualized projections were. And so it's really exciting. I'm so happy that I was connecting people to investments. And then I said to myself, what kind of impact could I have on the world if I shared this with even more people? So now I have this huge mission. This is how I met Carlotta. I had her speak on one of my summits. I do a lot of education around understanding syndications so that people are really comfortable to make the investment, because I think it's so perfect for so many people. Okay, this is a mandatory disclaimer before I start jumping into the numbers. And basically, my attorney wanted me to let everyone know this is not an actual offering. I'm not pitching an investment to you. Instead, I'm letting you know how it works, the structure, and the basic model, and then offering you guys a chance to book a call with me, and then we can go from there to look at some actual investments together. The game Monopoly is a real game. I love this from Kevin Hart. I went to an investment conference and he was speaking, and he was like, I'm just baffled. So many rich people don't take advantage of this. But it's so true, as Carlotta has showed you guys and talked to you about it all the time. Okay, so let's jump in. Okay, so multifamily syndication. Now, again, you could instead put the word here like office park syndication. But what happens basically is, so say we want to buy this apartment building and the purchase price is $1 million. Now that would be a steal for that apartment building, but I'm using $1 million because it's easy numbers. So what we do is we get a loan for 70%, just like a mortgage on a normal house. And then we still need the down payments of $300,000. There's closing costs, maybe some CapEx. So what we do is we take that building or mobile home park or whatever it is that we're buying, and we put it in an LLC. And this is why it's passive for you guys, because we don't split up the deed directly on the apartment building. We take the apartment building and we put it in an LLC. And so in an LLC, you have limited partners, who would be you guys, the passive investors, and you have general partners, which is, those are me and my partner. So you guys are entrepreneurs, you know how LLC works, the LPs and the GPs. So that the LPs, what they do, what their contribution is the capital. So when we're buying something, this is a pie representing all the capital we need to buy the apartment building. So about 60, maybe 70%, we get a loan. And about 30% of the acquisition price comes from, you can see that light pink piece of pie, those are the limited partners, so that would be you. And so in exchange, this is how the ownership pie is split up, the ownership for the LLC. So the LP investors get 70% ownership of the LLC that holds the apartment building. And then the general partners, me and my partners, we get 30% ownership. And this is the reason why that the returns on the back end are so strong for investors, because for 30% of the purchase price, you get appreciation on 70% of the value of the property, not on 30%. So because it's not a direct line, $1 in, you get, 1% of the purchase price, you get 1% ownership, that would give you much, much smaller returns. But because we give 70% of the ownership to the LP investors, that's why you get the strong capital gains on the back end, that appreciation. Okay, so then there's some more terminology that you guys would want to know if you're looking at a syndication offering. And so this is true for any syndication, any passive offering. So terminology, someone might say we have a syndication, someone might say we have a PPM, someone might say we have a private equity deal. What are some of the other, I think those are the most common. They all mean the same thing. It's all what I'm talking about right here, where the asset is put in an LLC and then investors become the limited partners in that LLC. Okay, so terminology, you'll see with these investments are the targeted cash on cash returns. And in this model, so I'm going to show you the model returns, how they look year over year. So for the sake of this, we'll say 8%. And this is very much what you might see out in the world right now. Targeted investor annualized returns. So this is different from the cash on cash returns. So this is basically, if you take, what you've earned through the whole life of the investment, so the cash on cash and the capital gains, and you divide it by the number of years you're in, what would that equal? And so the 20% includes that 8% year over year. And so that's very important to know. What are the annualized returns? And it's also different from IRR because the returns that you get, there's no compounded interest in this type of investment. So if you're looking at IRR, that would be another type of return. Investment profile. So this is going to be important for you to pay attention to so that you know when your returns will start. So we always do value add, meaning we take something that's already there and we're going to make it better. This means that the cash flow starts in the first year because there's already tenants in there, there's already renters. If something's going to be a new ground up development, you're going to want to pay attention to that. The depreciation and the tax benefit are going to be really different, and the time frame for when you get your returns is going to be really different. Because if it takes 2 years to build it and lease it up, then you're not getting any returns for those 2 years. So which is totally fine as long as you know, and that's totally fine with you. Another term is accredited investor. And so when you're looking at these private investments, the SEC regulates them and keeps their eye on them. And so there can be a 506C or a 506B. And that indicates whether it's for an accredited investor or not. And most of you probably already know what accredited investor means or how you qualify, but basically there's 2 ways. It's an either or. So either you can have a net worth of $1 million, not including your primary residence, or you can have an income of $200,000 or more per year, or you and your spouse together if you have an income of $300,000 or more per year. So either the 1 million or the income will qualify you as an accredited investor. Now, if you're not an accredited investor, you would look for something that says it's a 506B. And these will not be advertised. You won't find them on crowdfunding websites. If you are not an accredited investor, you need to get to know someone like me or my partners, someone who has offerings, because you'll only find out about them if you have a personal relationship with someone. So just know that if you're not an accredited investor, you still can invest in private investments. You just have to know someone. Targeted investment period. So PPMs syndications, they're not liquid. So it's not like the stock market, or it's not like a REIT where you can trade in and out. Your money will be locked up for the entire hold period. So it may say 3 years, it may say 5 years, it may say 7 years. Make sure you look at that and realize that your money is not liquid during that time. And I say that because, some people are like, after 2 years, oh, my kid's going to college, can I have my principal returned? No, because we bought real estate with it. It's not liquid. So really pay attention to that. If liquidity is important to you in a certain time frame, pay attention to the target investment period. And minimum investment, crowdfunding websites might go down to 5,000 as the minimum investment. Some really large private projects have the minimum at 250K. So just, before you start doing your due diligence and diving into a project, I'd say look at all these things to make sure, like at the surface level, it matches what you're looking to do in your investment strategy or in your tax planning strategy with Carlotta. Okay, so now I'm showing you a model. So given everything that we saw on the previous page, this is how it would practically work for you as far as your returns coming out. So you can see year 1 through 5, because the example was a 5-year hold, and it was an 8% cash on cash, which means you receive 8% return on your investment each year. So with a $100,000 investment, your yearly cash flow projections would be $8,000 per year. And it's paid quarterly, usually when working with us. If monthly payments are important to you, you can find syndicators who do monthly payments, but we do quarterly. So it means you'd get 2% return on your investment every quarter. You get $2,000 every quarter. So that's not going to bring you to retirement anytime early. However, when we sell the property, remember that investors have a disproportionate share of ownership for the money they put in. So you will be gaining appreciation on a large chunk of the property. So when we sell it, so we always have a business plan, a value add business plan, meaning we're working in a market that has rent shooting through the roof, or we're remodeling it, flipping it, repositioning it, so that when we sell it, that net operating income, which you all know as business owners, net operating income is how you buy and sell a business. So apartment buildings, retail parks, they're bought and sold on that operating income. It's not like a single family home, which is bought and sold based on what the market is doing, what people's hearts feel like, do people want to live here or not? It's based on facts, it's based on numbers, that net operating income. So we have a value add plan to get that net operating income up. And usually for every $1 that you increase the net operating income, you increase the purchase or the sale price by $10. And so if you have 70% of that appreciation, that's how you're really, riding this wave of the value add business plan. So in this example, say we sell it, and when we sell it, you get a check for $60,000, and you get your principal investment returned. So then where does the 20% annualized returns come in? How is that calculated? Okay, if you take a look and you add up the yearly cash flow you would have received, that would be $40,000. And then the proceeds from sale are $60,000. So if you add those together, that's $100,000. And again, I use these numbers because they come out really clean, but these are also really close to reality. So if you take your cash flow plus your proceeds from the sale on the back end, plus your principal investment returned, you now have $200,000, not taking into account any tax, which I'll hit on that in a couple slides, and I'll let Carlotta expand on that piece of it because she's obviously the expert there. But this, if you look and you find something that has 20% annualized returns, even though you're not getting it each year in the form of cash flow, you can find syndications and investments that will double your money in 5 years. And lots of what we're seeing right now is actually that people are able to meet their 5-year projections in like 3 or 4 years because the market's very favorable right now. So that it's pretty awesome. It's a pretty exciting time to be in real estate. And I always get the question about, well, how can I invest? Like, what are the ways that I can invest? So the obvious one is cash. So like I have some money in my savings. I have $100,000. I just invest. I invest in my name, Sarah Sullivan. Okay. Um, or I can invest with my self-directed IRA. So I don't know if you guys, if some of you used to be in W-2 jobs and you had 401ks, you can roll those old 401ks or IRAs into a self-directed account. And that allows you to invest in real estate. So not just syndications, but you can invest in single family home rentals, short-term rentals, all kinds of different real estate opportunities with your self-directed IRA. Now, most of you being entrepreneurs, you probably have solo 401ks, unless Carlotta says they're not a good idea. I know different tax people have different opinions on that. And I don't have one because some people say no, but some people say it's great. So if you have one, know that you can invest in syndications with your solo 401k. You simply, when you're filling out the subscription paperwork, you say the owner is the name of your solo 401k. Then it directly owns a share in the syndication. And you can pretty much use any LLC. So if your business has passive income, then you can invest in the name of your business and enjoy some of the bonus depreciation to offset passive income in your business. Now, not always, that's uncommon, but maybe you do. So talk to Carlotta if that's going to be a good strategy for you. If you have a trust, like a family trust, the trust can hold this type of investment. Nonprofits, you can invest with your nonprofit if you have one. Pretty much any type of entity. I can't think of an entity that would not be able to hold this type of investment. So it's very flexible. And when you're making the decision, a lot of people ask me like, which one should I invest with? Because I have money in all these places. And I always say, ask your tax, your tax strategist, your CPA, because there's different tax implications for each of these, which is why on the previous slide, I didn't take into account any tax, because it's going to be taxed totally different depending on if it's a retirement account, non-retirement account. And then I also want to say what I'm seeing a lot of people do right now, which may interest you guys, is to turn debt into an asset. And this is not always popular with everyone, but very popular with other people. Oh, Zanya, nice hair. So lots of people, because money is so cheap right now, people are doing cash out refinances, getting lines of credits on different things. Cash value life insurance, they're taking out, loans or lines of credit against their cash value life insurance. EIDL right now, you guys being business owners, if you're familiar with this is actually super popular right now because the money is really cheap. It's like the low threes as far as the percent, the interest rate you have to pay. You don't have to pay back the loan payments don't start for 2 years, 24 months, I believe. And so that leaves time for you to start getting your investment going before you're going to need to start paying your payments on that. So it's really strong. You can take advantage of the arbitrage in this situation. Now, talk to Carlotta if you want to use one of these strategies, and she can help you decide if this is right for you and your business and what you're looking to do with your investing and your wealth building. But I want to throw that in there because a lot of my larger, more sophisticated investors are doing this, where they're taking the cheap money that's available right now and they're putting it into something that's yielding the 20% annualized returns. And they're like, hey, it's free money, basically. So check that out. Now, I want to jump in and talk about, I'm going to move my little image, the bonus depreciation. So in a sec, Carlotta, I'd like you to, unless everyone knows, does everyone know already what bonus depreciation is and how it works, Carlotta?
I mean, we talk about depreciation a lot.
Okay.
It's pretty much, guys, it's just an expense that you're taking for something that's going up in value. So when you're when you're taking, well, I mean, for the most part, when it comes to real estate, the asset's going up in value and you're taking an expense for it. So bonus depreciation, cost segregation, depreciation in general is just an expense for an asset.
Exactly. So for all of our syndications, we do a cost segregation analysis, and the goal is always to do them in the first year purchased. And because there's so much personal property in apartment buildings, the refrigerators, the carpet, those all have 5-year lifespan. So we can take the 27 years depreciation and accelerate it and take most of it in the first year. And so each project that we present as investment opportunities to investors, we give an estimate of the bonus depreciation. So for instance, we have one open right now that's supposed to be, we estimate it'll be about 75% bonus depreciation, which means if you invest $100,000 directly into one of these investments, you would get $75,000 bonus depreciation on your 2021 K1. And so you can take that against passive income that you have in 2021 and, basically deduct it so that you have a lower tax basis. Or if you don't, you can use it against future income from this investment. So for instance, you see here, the cash flow is 40K over 5 years. So you wouldn't need to pay any tax for those 5 years on the cash flow, because that only comes to 40,000 and you have 75K in your bonus depreciation bucket. Now, when it comes time to proceeds from sale, and that's considered capital gains, then you get up over, over the 75K that you've been allotted, and then your principal investment. Those are, I don't pretend to say the nuances of how that's taxed. But the benefit is that the taxes are pushed down the road. So there is a recapture on the back end. We do what we can to reduce the recapture so that it's not 100% recapture. And also the benefit is that it's usually taxed at long-term capital gains instead of ordinary income. So that's going to be a lower amount. Carlotta, is there anything else that you'd like to say about how
the thing
tax,
is, they just have to make sure that they meet the qualifications for the depreciation, right? Like it's not, you can't necessarily take them in the current year. You might have to move them forward. It just depends on the situation. So this is stuff we would talk about if you're interested in your year-end strategy call, which all of you guys are in the middle of right now.
Yeah. So like I said, it's the passive, it can be used against the passive income or carried forward. So, for like the preceding year's cash flow.
Or if they're a real estate pro, they can group it with their other properties and we can make it a current deduction.
Yeah. Yeah. So we do have one open right now. If you guys are interested and you're doing your year-end tax strategy planning with Carlotta and you're interested, reach out, let's chat and see if this is right for you. After you talk to Carlotta, if she says, hey, this would be a great idea for you and here's the benefits.
And they can go ahead and reach out to you without talking to us, but just before they invest, they need to make sure that what they're thinking is going to be the useful that it actually is all I'm saying. So just definitely get on a call with Sarah if you're interested in going this route. And once you and Sarah speak and you're like, yes, this is what I want to do, then come back to us and make sure that the strategy portion makes sense.
Yeah. And a lot of people are jumping in right now because they are doing their end of year tax strategy calls with their CPAs. And then they're like, wait, we need to dump some money somewhere that has that bonus depreciation. So all the models that I was talking about so far are if you were going to invest directly into a single situation. So like a single mobile home park or a single apartment building. So an LLC that holds one asset. Now, another option for you guys is investing in a fund. And this fund, so I have a fund that's for qualified clients, accredited investors only. And so this is how it would work. What my fund invests in, it's syndications. So if you are like, wow, it sounds great, but I don't want to make one investment in one building. I like diversification. If diversification is important to you or cash flow is important to you, for those of my investors who that's important for, I created the fund. So basically, all the individual syndications that I present to my investors, I made a fund, and the fund holds a portion of all those as well. So it's diversified across properties and across regions as well, across markets. And so for this one, it's a 12% cash flow. It's flat. So what that means is there's 12 for a $100,000 investment, $12,000 per year. At the end, there's no proceeds from sale. And at the end, your original investment is returned. Now for the fund, it's close to 100% bonus depreciation. And so you'll get a little bit more depreciation if you invest directly in the fund, just because it has some projects in it that have more than 100% bonus depreciation and some that have less. So if that's important to you, this is also an option that's out there. And so this one's even more passive because you make one investment. It can be any dollar amount above 100K. So if you're like, yes, this looks interesting, I want to talk to Sarah more about this, you can go to sarahs360.com and there's all my contact information. You can book a call with me, those sort of things. But what you really want to do in all of these passive investments, since you're passive, the most important thing is to do due diligence on people first. So there are so many people like me who are out there on the internet and all claiming the same thing. And some people have been wildly successful in this for, the past 10 years, and some people are just starting out. There's all kinds of, there's so much stuff out there, guys. So really, I always tell investors, first do your due diligence on the people before you start getting all excited about the returns. And so the people include the sponsors. So that's like me and my partners, and also the property management team. There's an extended team involved in all of these. There's an SEC attorney. We have a CPA for the syndications and for the fund. The property management team on these, because it's not a 5-unit, it's like 300 units. So we have full-time staff on site, property management companies. It's so important to do your due diligence on all the people involved, because one person being, a sideways actor in this can halt the business plan, which affects the returns for investors. So it's super important. And so I don't think I'll have time to go super deep into this today. But if you guys want more info, I have like pre-recorded webinars on this I can send to you. How to do due diligence on the people and read track records. Actually, I'll just give a little bit more on the people. So for track records, I've had the experience where I ask someone for a track record and they show me their portfolio. That doesn't tell me anything. You could have 10 apartment buildings and they're all losing money for investors, or they're all, bankrupt. Or if someone says, my assets under management, it's, like for me, it's $140 million assets under management. So that doesn't tell you anything either. That doesn't tell you, how investors are experiencing their return on investment. So it's really, really important when asking for a track record is to ask, what were the projected returns and what were the actual returns? Because if actual returns were 10%, that also doesn't tell you, was that good or bad? Did they exceed or not exceed projections? So if you thought it was gonna be 20 and it was only 10, they overpromised, underdelivered. If they said it was going to be 6 and you got 10, then they underpromised, overdelivered. So you really want to always look at a track record as, from an investor point of view, what was projected and what was actual. Because even sometimes people will give you the cash on cash of the whole property, but they could have been taking that as the GP team and investors might not have gotten very much. So track record is so important to review. And it's not always going to be 100% awesome, pretty roses. So if someone presents a track record and, one or two of their properties were underperformers, but they tell you what happened and they tell you what they learned. Like for me, I got burned by a property management team. And so now my due diligence is so extended with the property management team because I got burned. And I don't want that experience for me or my investors anymore. That was one of my first properties. But yeah, so also if someone presents a track record and it has no flaws in it, that may not be, it could be a warning that they aren't including everything. So our SEC attorney, she says, you can't give an example of 2 properties and they're your best properties. If someone wants to see an example of your offerings, you have to show everything and how you performed. So just be really diligent if someone gives you all, like, everything was 40% annualized, we didn't have any hiccups anywhere. And another thing is, I've had people, when I ask for their track record, they present me 5 buildings and I add up the number of units, and the number of units comes to 1,000. And then they also in tandem told me that they have owned over 5,000 units. So, that's an indicator, hey, they're not showing you everything. And I always say if there's one number that doesn't line up, I usually walk away because that's one sign of either they're being careless or dishonest. And you don't really want either of those when you're investing your hard-earned money with them, right? And so that's the sponsors. The property management team, a good way to do due diligence on them is to look up the ratings of properties that they're currently owning. So normally, like we normally bring in a new property management team because usually we buy something that is needing help because the current property management company isn't doing well. So take a look at, if we say, hey, we're buying this property, we're going to use this new property management company, ABC Properties. Look up ABC Properties. What do they currently own? Look at the comments on apartments.com. Is everyone like, oh my gosh, the guy who's in the leasing office is a jerk, or they never take care of any of, I've had this broken light bulb for 3 months or this leaky faucet for 3 months. That's usually the property management is not good. Now, if some of the things are saying, oh, the pool needs repair, or so this and that is outdated, then that's usually the owner is not putting in CapEx. That's not really property management's fault, that things are deferred maintenance type things. But that's the way you can take a look at, and you can see ratings for them. You can Google, all these people that are listed here. It's just really important to do. So if you find a group that you like and you want to work with them, and then ask them, what markets do you play in? So usually people are localized, specialized in certain markets. So those of you in real estate know that there's no such thing as a US real estate market, right? South Carolina and California are not identical in any way, shape, or form. So, who's leaving, who's coming and going, what type of person, what type of renter. So there's so many things that you can look at, and you want to look at it by county and by city. So for instance, we're in Texas, we're in the greater Dallas area, we're in Columbia, South Carolina, and we're in various cities in Georgia. So I have 11 apartment buildings, and those are the 3 areas. I don't have them in 11 different states around the US. And it doesn't mean there aren't other markets that are great. It just means that's where my teams are, that's where I'm localized. So take a look. Usually people, they might be in the Northeast, and they have stuff in Seattle and in that area, and Oregon. And so take a look at all these market stats in order to see if you feel comfortable that that's a long-term game plan. So you're going to look at population and household and what's going on with those numbers. So you always want to look at 2 years in the past and 2 years in the future. And you might say, oh my gosh, this is a lot, Sarah. But if you, write this down, re-listen to it, it takes you like half an hour on Google to do this. And it's important to do because, half an hour, 60 minutes on Google, evaluating an offering, it's worth getting it right, because $100,000 is no joke for you, right? So you want to make sure the population has been going up over the past 2 years and is projected to go up in the next 2 years higher than what's going on in the rest of the US. So just knowing, oh, it's going up 6%. Okay. Well, the US is going up at 7%. So that means, that's, even though it's increasing, it's decreasing, relatively decreasing. So you want to look at all these numbers here: job announcements, job growth, vacancy rates, market rents, and look at it compared to what's going on in the US, household growth compared to the US. Also, it's really cool right now because the human migration patterns it's happening so much faster because of COVID. So U-Haul and companies like that, they literally publish every month what states and what cities have the most people coming to them and the most people leaving them. So even though you might get something really cheap that seems like a great deal in a city, but everyone's leaving it, that's not a long-term good plan. So look at all that data, make sure that household formations are growing, population's growing, and that job growth in the type of jobs that'll populate the product that you're looking to move into. So for instance, we always have apartment buildings are rated A, B, C, and D. So we're always in we buy something that's like a C+ or a B- and we bring it up to a B+. So if the job growth is all in executives and finance, and they're going to buy their own homes, or they want the A+ luxury condos, we have the wrong product for them. So that's not going to be a good match. So you also want to make sure that whatever the job announcements are, or say we have this beautiful B+ property and the job announcements are for jobs for, with those jobs, people couldn't afford that apartment building, it's a mismatch. So making sure that the product matches the market data is super important. So if all those things check out, you like the team, you like the market, it's growing, then you can take a look at the property and do your due diligence on the offering. And so even though I'm explaining this for multifamily syndication, again, this would be your same process for any syndication, or even if you're buying your own duplex, because the property management team is probably, you're going to have one managing your duplex. Where you buy your duplex, you're going to want to look at all the market data before you buy, because where you live may not be the best place to buy. Like I live in California. I am not buying a duplex in California. A, it doesn't cash flow. B, who wants to be a landlord in California? No one. It's awful. But your market might be great where you live, or you might buy in another market and have a management team manage it. And so finally, the property. So these, if you're far away and you're investing in something passively, I suggest doing a Google Street View, look at the neighborhood, make sure it checks out, because you might get in the offering packet, pictures that are, you get this much photo. And so what's going on surrounding, what's around it? Really take a look at that. And that's the easy way, you don't have to drive out to Dallas and take a look at the property. You can look at Google Street View with the pictures that are in the property packet, and make a judgment from that. And again, for the property, look at the rents and the vacancy rates and compare them to what's going on in the market. So usually someone will have all this material for you, but you just want to make sure that it's an opportunity, right? That it's a strong opportunity. So if the vacancy rates are, 20% is vacant, but in the market only 5% is vacant, that's fabulous. That means a great property management team is going to come in, it's going to fill up that property, net operating income is going to go up, and you've got a really easy winner right there. So there's some great opportunities. Just wanted to give you guys a high level on how to do your due diligence, how to evaluate things that I think are really important to look at. And the reason I do this is because I want you to feel confident investing in multifamily, and I want you to make the choice that's right for you and finding the good stuff. So I'm going to skip through the deep dive slides, but again, if you guys want to know more about deep diving into market stats or deep diving into evaluating a property, shoot me an email and I can give you a longer recording on that type of stuff. And then here's my invitation for you guys. So take out your phones and go to sarahs360.com. And so open it up, go to sarahs360.com. I'm going to do it with you. sarahs360.com. Don't forget the S, otherwise you'll get a different Sarah. She's very cool. I know her, but she's not me. So once you're in there, you'll see the first box in the top right-hand corner says contact. So if you click that, you'll have my phone number, my WhatsApp, my how to schedule a call. I see my email is not in there. So let me add my email. That's good to see. A good thing I looked with you guys. But those are all ways to get in touch with me. And then if you bookmark this page, you'll see whenever we have events, I put it on the events tab. And then the very last right-hand box says schedule. Again, you can click that and you can schedule a chat. You can also schedule a personal investment strategy session. So lots of times people think one type of real estate investing is great for them, but in fact, another type of investment would be better. And so you guys have Carlotta, but if you also want to discuss it with me from purely an investor point of view, then go ahead and book an investment consultation with me. I'd be happy to talk to any of you about it. And so what I go through, it's like boom, boom, boom. I've done this with hundreds of people. We go through and we figure out what type of investing is right for you, where you'll find the money to invest, like looking at that, your self-directed, your 401k, your different assets that maybe you can leverage. Where you'll find the money to invest. That's what I mean by that. The passive income you'll be able to generate. So I love to do models for people and show, if your goal is in 10 years to have X number of passive income, how are we going to get you there? So let's find some appreciating assets early on, cash flowing assets later on. And then I, of course, will connect you to the investments. That's what I love doing. So that's the end of my presentation. I look forward to chatting with all of you. And I'm fine to take some questions. If you guys would like to ask me anything, I'm here.
So first off, I just want you guys to know Sarah does have an active investment that you guys can get in on. She doesn't always have those. So that's why I booked her for-profit pathway, because our goal here is to bring actual opportunities to you so you can see if it's the right fit for you. Obviously, I think that's the biggest problem with entrepreneurs. We really don't know how to get the investments. We hear about them, but we don't know how. So this is great opportunity for an apartment syndication if that's what you're looking for. Remember, like I said, it's you're totally hands off and higher return usually than the market. So if you have money sitting in a old 401k from work, or maybe you've done a 401k to get your QBI down, this might be something that you're interested in. I like this better for 401ks than investing it in a business that you're doing, because any appreciation has to go back into that 401k. So this is just really a clean option. So yeah, what questions do you guys have? Put them in the chat and I'll kind of go through the chat and talk through what those things are. Let's see. It says, I'd like to talk more about moving my 403B to self-directed IRA. Is there a registration or some kind of certification to become an accredited investor to invest in the fund?
Yeah, I can answer that one really quick. So there is, I use a third party. And so if you're interested in the fund, I pay for it. So part of the registration process is I just send you a link and you work with the third party. So you would submit either your tax returns or some sort of net worth, like if you have your money in an account, you submit them some documents showing that you're worth $1 million. So I don't see any of that stuff. It's a secured third party. And then they send me a certificate and do a certificate so that you can invest in the fund. And then you can use that as well for other investments that require you to be an accredited investor. And I don't know about moving a 403B to a self-directed IRA. I'm not certain what a 403B is.
It's for like schools. You can do it.
Okay.
You just move it. You could just roll it over to a 401k and then out to a solo 401k.
There you go, Terry. Carlotta, do you have like someone you recommend to people usually to do that? Because otherwise I could recommend someone.
No, I've got, I
Okay.
mean, there's several people, but I don't have a relationship with anyone.
Okay. So if you guys are thinking about doing that, there, like Carlotta said, there's like 15 companies that have self-directed IRAs or solo 401ks, but U-Direct IRA, I found to be, so I worked with several over the last few years. I don't have a formal working relationship, but what my investors tell me is that when I sent them to U-Direct, I got the most positive feedback. And so they were the fastest and the cheapest as far as their fees. And so that's U-Direct IRA if you wanted to roll something into a self-directed account. Charan, I hope I said your name right, or Sharon, or
Chair on,
Sharon. Karen, okay, I was really,
chair
really
on.
off.
It's like chair on.
Chair
I
on.
always do it wrong.
Okay.
I can tell you it's chair in. Take a
Oh, I
chair
was
position.
still wrong.
Charon. Okay, Charon. The difference between something like Real Crowd versus Your Opportunity. So there are crowdfunding websites, and on there they have syndications, which are exactly the same as what I'm talking about. So if I wanted to go onto a crowdfunding website, I could take my syndication and put it on there. I have to pay them 30% to 40% of my equity. And so I don't want to do that because that's really expensive for me. But usually they take it from the sponsor or the GP side and not from the LP investor side. So it's really just, if someone is not focused on raising capital, they can go to a crowdfunding website. But other than that, the structure is the same. Something cool about a lot of crowdfunding websites, though, if there's been the same sponsor who's been with them for like 5 years or something, then they'll have their track record on there. So you can see, like if you ask for my track record, I'll give it to you. You can talk to some of my investors, but there's not like a third party validating my track record, right? But if you're on a crowdfunding website and there's the track record there, they'll have validated it for you. If it's something that was on their site, then they know, right? So I think that's another level of like confidence that you can have. But really, that's the only difference. Why has no one told me I could take my own money out? Well, there you go. There's my PSA for the day, Terry.
Because I don't want you to whittle away at it and then you go direct 401k it into some company and then you're like, Carlotta, what do I do with this 401k? I self-directed into this complicated business. And then I'm like, Terry, now I have to do all the financials for this 401k and it is an extreme mess. So when you're doing something simple like this, I recommend it. But if you're going and buying a business with it, I don't recommend it because it's just not, it's terrible.
Complicated. All right. If using EIDL, how do we justify the investment into this with government qualifications? So I don't know because I haven't done it or I'm not doing it, but other investors have done it. And so I don't know what their justifications were. They didn't say they were, I don't know if you have to say what your use for it is.
Yeah, I would say
I don't know.
you've got to say that you're using it. Okay. So what they're probably doing is taking the EIDL and using it for their expenses in their business and then taking the gross revenue out of their business. But because you can't use EIDL directly for this.
Okay, cool. Thanks for that. Yeah, I don't know the details. I just know I've seen people doing it and then putting money with me. So awesome. Cool.
Sarah, I appreciate you being here and I will send this out to everyone else.
Okay, awesome. Love it.
You guys go book a call with Sarah if you are interested.
Yeah, and when you share it out, Carlotta, share that sarahs360.com, and then that's easy. People can get in contact forever.
Okay.
Yeah. Awesome. Thank you. Great to meet you all. I hope that we talk soon. Thanks for having me, Carlotta. I really appreciate it.
Thank you. And I'll be sharing it out.
All right. All right. Bye, everyone.
Bye.